Hello and good morning, listeners. Welcome back to Almus Market Mornings with me, Shikhar Garg. And folks, it's an interesting day out here as there's a lot of mess, chaos, and preparations all at the same time as Prime Minister Modi arrives in Mumbai. If we have to talk about financial updates, folks, Fed policymakers are still continuing their stance of further rate hikes to beat inflation, whereas oil, on the other hand, has showed some decline on the recession expectations. So it's a tightrope to walk on, managing the inflation as well as not hurting the growth and avoiding recession. It needs to be seen what central banks would be doing. And as we were talking about oil, there's an interesting update on the oil front. Saudi just mentioned opening of their trade settlements in currencies other than dollar for oil. Now that's quite an interesting update that we have seen. And other than that, BOJ had its meeting yesterday, which left more or less the policy unchanged. So, JK, I'd like to know from you, like, what are the things that we should be expecting after not much change by the BOJ and still adamant Fed on the rate hike front?
Good morning. Yeah, I think it's not just Fed who is adamant, it is the BOJ as well, because they disappointed the market by not changing any of the parameters of their policy. In fact, it was a day full of market moving events, and the markets did swing both ways to the tunes of the numbers and policymakers' statements. First, it was the Bank of Japan, who, contrary to what some expected, uh, and what should have been logical, kept all policy parameters unchanged, including inflation forecast. They vowed to continue buying unlimited amount of JGBs and pursue the yield curve control. Immediate market reaction was to sell the yen, which moved above 131 in a jiffy, but by European time was back near 128 as market realized that such a stance was unsustainable. Just for a perspective, BOJ has bought a staggering 12 trillion yen worth of bonds in mere 4 days, which exceeds any single month purchase. And it is assessed that at this rate, it has some 33 weeks or before or so before no bonds are left in the private hands. So that is a big number of statistics. They did have a short-term success in bringing down the yields, but I believe Japanese current rigid policy is very likely to lead to a big market turbulence sooner or later, because it is very artificially held down. As for the yen, it should stay on the stronger side due to fears of large-scale deleveraging of global assets invested with the yen carry trade. UK inflation was next up and was a surprise to the markets. They had to contend with the core inflation rate, which is higher both in MOM and YOI terms. And this is in contrast to what we have seen in US and Europe. Impact was to push up gilt yields higher and sterling to retest 1.2450 December high. Data keeps alive another 0.5% increase in policy rate by Bank of England. While GBP has since retraced in line with overall dollar recovery, it still stays stronger against other currencies. The stateside data was the ultimate punch the market, faced as weak data of retail sales, PPI inflation, industrial production, regional manufacturing service, all falling and below expectations, rekindled bad news is bad news sentiment among investors. The weak data has supported a recession view in 2023, pushing back on the soft landing narrative that has pervaded markets since beginning of the year. The New York Fed also released their 3-month over 10-year yield curve recession indicator for December, with it model ascribing a 47.3% chance of a recession, the highest in since 1982. This, along with the continued Fed hawkish speak, yesterday by Mester and Bullard, was enough to decide the direction for equities, which lost about 1.81 for the Dow and more than 1.5% loss for the global composite index. While the indices are still green for the year, they have hit a big resistance on the technical charts. And with good news becoming rare, downside looks more vulnerable to me. The big fall in yields further confirm a sober view on the economy, with 10-year trading at 3.36%, a level last seen in September 2022, and after which it had made a new cycle high at 4.33. Thus, we are now nearly a full percentage lower. Yield curve is steepening again at minus 72 points. Dollar posted strong gain on the back of poor risk sentiment, and dollar index traded well above 102 after initially falling after the data. Euro in particular has failed several times above 108.50 and now seems set to break 1.07 eventually. The growth-related currencies, Aussie and CAD, have fallen heavily, clearly confirming the recession fears. GBP is currently better placed due to higher rate prospects, but should eventually succumb to fears of stagflation there. Asian EMs have been holding up better with relatively better growth prospects, particularly China being viewed by many investors as recovering strongly. It was one of those days when rupee outperformed. In fact, the fall of 40 paisa intraday backed by flows was seen after a very long time. And it is probably set to continue its short-term outperformance because we hear a lot of flows are lined up, and the current scenario of global recession fears contrasted with India's superior growth prospects may play out. At the same time, as global bond yields fall, I think Indian bonds are becoming more attractive at 7.3, 7.4%. And I think it's sooner or later foreign funds find it attractive to invest in Indian bonds. So I guess the flows should continue for some time. And with oil also dipping yesterday on recession fears, it's added advantage for the rupee, at least for now. 81 remains a strong level on the charts, and probably 81, 70, 80 is a very good level where we can be shorting for 1 month perspective. But for a medium term, what was not such a good news, International Energy Agency reported that demand for oil is expected to reach a record daily average this year, with about half of the growth coming from a rebound in China. Further lift in oil prices, in fact, some suggesting that a return to 100 per barrel could happen, but probably this will take some time because right now what's overwhelming in the market is the recession fears in major economies. So we can be, relaxed for some time and face these music later when it comes. Thank you.
Okay, JK, and thank you so much. I mean, folks, we've been seeing kind of a strength in INR, and this has been a move from the past couple of days, or rather, past couple of weeks. But it's interesting to see how the flows have been coming in the domestic markets and from the global markets as well, to put some strength for the INR against the dollar. Though the concerns on the medium term, as JK mentioned, would be towards the kind of demand we'll be seeing for oil on the rebound of China on the growth front, as well as if we avoid recessions, as most of the central banks have been trying to. But on the recession front, as we heard, the US New York Fed model has predicted a chance of 47.3% of recession, which is quite high. And it's almost around the corner that we can see a lot of economies grappling with inflation as well as recession. So and inflation, as we see, UK just released their inflation data yesterday, and it was higher for both. Core inflation was higher for both year on year and month on month terms. So there's a lot of things happening, and central banks have been trying to avoid a lot of distress when it comes to growth. But it can be observed, as market participants have been observing, just like BOJ, a lot of disappointing actions from them. So let's see how things go by in the markets ahead. We shall come back again with another round of update. Thank you so much for listening.